so much for taking the time out to attend this session. This session, when we hear the topic name, typically seems very theoretical concept. I also see my son studying for a similar subject in one of his, as part of his overall curriculum. But it's very important. It involves knowing about ourselves, what guides us, what motivates us, what desires we have. It's an interesting thing if you actually get deeper into this particular subject line. So without much further ado, I'll try giving as many examples as possible based on my experience. Even most of the slides while I was working on this particular presentation was I could recall specific incidents where a client has said something, they showed a particular side of the about themselves, which made it even more interesting for me to work on their particular plan. So let me just start. Yeah. So the agenda of this particular session, one most important before I even specify the agenda is the intent is not to judge anybody or anybody's desire or wish or wanting some particular thing, but it is to be aware of certain behavioral biases which typically come in the picture. Please understand emotions, behavioral biases are needed, are mandatory, will always be there. We are not humans if that is not there. That is what guides us, that is what pushes us. So these are given, but just be aware of it like every other aspect in life. Even in investing, your finances is something, is a major chunk of what you turn out to be as a person over the years. So at every stage, these biases, these emotions will be guiding you. So it is very important to have a check on them, or more than check, it is to be aware about them. So we'll understand what these biases are, what are the emotions, how they are connected, how they could affect financial planning. The core expertise of my organization, we have seen day in and day out where we try convincing a client that this is what they're thinking is, this is what could happen, this is what needs to be done. There is no right approach. It is more a sense our intent is to be more of a sounding board. Second thing that I would like to specify is I'm no expert in this domain. Lot of what I'm going to speak over the next few minutes is based totally on my experience having done so many financial plans for several clients. Okay, so we will touch upon behavioral biases, what are the different emotions, how do they affect financial planning with a particular example of child education, and key attitudes some attitudes that need to change when you're set out on your investment journey. For those who, in case someone has not come across this book, Psychology of Money, I would strongly recommend it. You can read it multiple times and you would have still not absorbed the entire gist of it. Please refer to this book. It's a very interesting read, whether you are somebody who's into the investment journey or not. So financial success, according to him, is not a hard science. It's a soft skill where how you behave is more important than what you know. I can't vouch for this more. The 20 years, 21 years that we have been, Right Horizons has been in the investment advisory domain. We have repeatedly been advising clients on their finances and how to achieve their goals. It's not the most intelligent, not the smartest, not the one who's really on top of their career, who sometimes achieve their goals. It is a lot of other personal attributes that has helped people achieve their goals. I cannot vouch for this particular sentence more. It's like bang on for somebody from my domain. So why should we even consider this topic? See, each one of us look at money very differently. A lot of things, lot of layers come into the picture when we look at money. It may be your current circumstance, your past circumstance, some childhood incident, how you have grown as a person. Lot of layers come into this particular picture. Lot of your spending habits, for most of us at least, is rooted in our childhood. When we were kids, we were subconsciously, it was given to us that this can be done, this should be done, this is something we need to be careful, this is overspending. Of course, things changed as our earning capability improved when we compared it with our parents, but still certain grounded values don't change. So a lot of your spending habits may be rooted in your childhood. The way the country is, the economy is, also govern your spending habits. If you come from some country which is not doing exceedingly well, you will see a different approach towards investing and spending, typically from such citizens of such countries. So every decision that we take could be an outcome of a lot of biases, how you interpret a particular incident, your emotional responses. When I've said information interpretation, a very recent event comes to my mind, and something which I was asking a lot of people to just to gauge, understand their opinion, and that was the Ambani wedding of Anant Ambani and Radhika Merchant. It was very interesting. It was a lot of time pass for most of us, because we always had some news on social media to keep scrolling through to see who attended, who didn't attend, who danced, who didn't dance. But what hit most of us probably is the opulence, the display of wealth, the grandeurs of the entire event, how it was done, the kind of planning. I was told that I read somewhere that there were so many outlets that were set up to cater to the international guests. There were huge revenues and sales even for them. So there were different ways of looking at it. There were many people who publicly voiced that this is like too much opulence, too much display of wealth, which is not right. That's just a one viewpoint. There were many people who said, what's wrong? The economy is doing well. People are buying. There is no illegal money that is being circulated. They were gifting people in crores. So there was a business transaction. Most business transactions are done during such occasions. So it was a lot of different viewpoints that came in. And if you look at each viewpoint, it gives you a perspective on what is important for that person and how they view it. Nothing right or wrong about what happened, but it was a very interesting incident for me to understand how people were thinking about it. Again, when you talk about psychology of money, and this is something that I just put while working on this presentation, because when I interact with people, these are typically the 4 recent goals or areas where you tend to see layers in people or shades of people. One is marriage. A lot of the older generation would still like to have a nice grand wedding for their children, especially women. When I interact with women, they would still like their children to have a nice traditional grand wedding, and definitely want this as a very important goal. When I speak to their children, they say, Auntie, simple wedding, simple arrangements. I'd rather spend it on a vacation or a honeymoon later, but I don't want to spend it so much on a wedding. So there you see 2 different kind of desires or viewpoints come into picture. Vacation as a goal has become so important. Increasingly, we see so many clients specifying vacation, whether they are earning well, they are not earning well. And what is also changing that the change that we are observing is a domestic vacation and an international vacation. Mind you, not everybody can afford that international vacation, but still there is an international vacation that people put in at least once in 2-3 years. So this is again another aspiration, another desire or change that we are seeing. Healthy lifestyle. Now, gone are those days when only till you're 40, 45 or 50 that you probably took care of your health the way they used to, or you used to be healthy. We see people being very healthy even in their 70s and 80s, which is a very good development as a country, as people. It's a very good progressive thing that is happening in our society. There is a conscious effort by people to allocate something for their health on a monthly basis, on an annual basis, as well as for emergencies. So that's another changing trend that we see. And last, one of the other important goals where I am seeing a change when I talk to people about financial planning or personal, about their personal finances, is the need for upskilling across all age groups. It's not restricted to someone who's young and who's just graduated and they want to do something further, study something further. Because of probably job insecurity and changing job scenarios, the need to upskill is really high now. So even if somebody is in their early 50s, I see people constantly putting in that effort, allocating a few lakhs every year to upskill themselves. So these are just goals that came to my mind, where I see a lot of changes in the way people are viewing it and how they would like to allocate something specifically for it. So we'll go to the first part of it, behavioral biases. I'll just touch. Many of you would have read about it, probably even when you studied. We'll just touch upon it. So what are behavioral biases? So they are preconceived notions or prejudices that influence our investment decisions. We don't obviously see it when we do it, but they are there. They're there in the subconscious level. So it could be bias towards your thinking of a particular way of thinking, a stock, a viewpoint, anything, any one of them. Understand that nothing wrong with having a bias. That is what drives us. That is what will make us take a decision. But it's good to be aware of sometimes of it, especially in case it's hampering, it's going to impact you negatively. Some of the most important ones I will touch upon. The first is loss aversion. This is the most common one. And that is either you're so scared of booking a loss. So suppose I give you 10,000 rupees. You are happy that you're taking 10,000 rupees from me. Tomorrow you invest in that same 10,000 rupees in a stock and you incur loss. The loss will typically tends to hit that person, pinch that person a lot more than the joy of you receiving the 10,000 as a gift from someone. So people are very averse to booking a loss, and because they're very averse to booking a loss, they just want to hold on to it. Similar with life, we want to hold on to some emotions, some feelings, and very difficult to let go. So we don't want to book a loss and see a loss that we have made a wrong decision. Probably there's a deep down one ego also associated with it. I'm no expert again in psychology, but I'm just thinking aloud. Probably there's an ego element also to it. So loss aversion is one of the most common biases people have. Second is selling too early. There is a probably a black swan event or some market correction. People start incurring losses. Maybe they just want to exit and they sell it too early. They don't wait even to see what is happening, understand the impact of which event is creating this particular impact on their investment journey. There are so many examples where probably a stock has corrected and then had a big run up. So selling too early because people do not want to face too many losses. And third and most important thing is avoiding investments to avoid a loss. When we tell people, especially on the financial planning front, we tell people, see, sometimes you need to be invested in equities for this particular goal, something like a retirement or a child education, which requires consistent structured investing over a very significant period of time. And you need to be invested in equities. People are like, no, 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 that is too much risk. I don't want to take loss. You mean to say my money will turn negative? What will happen if I turn? We try telling them it will not become zero. It will just turn negative, maybe, because market conditions, we can't time the market, we can't predict the market. But that we do come across people who are very averse to any kind of a loss. So this is a very most common bias that we see. Second is FOMO. This we have recently seeing, especially with cryptos. I was very, very surprised 2 days back. A gentleman, he's probably in his late 70s. He and his daughter are my clients. He came and told me that, do you know, can you suggest some good platform for crypto? I said, as a house, we do not recommend it because it's not regulated. And I have zero knowledge on it, so I will not recommend it. Be very careful. There is no basis on which you can gauge the price, or rather, I would say, I don't know. My knowledge is limited in this. He said, no, madam, Trump is supporting cryptos a lot, and I think we will really gain. So my daughter is also for putting a specific allocation into it. Nothing wrong. They may be bang on, they may be right. I'm just saying it is also the fear of missing out. Oh, there is an opportunity here that is really going to give me good money. We have seen so many of them. So many people have put money, who have made money, who have also lost money, again made money. So I will not judge specifically on the crypto thing. So there is a section which feels I should not be losing out. Another a particular product asset category where increasingly I was seeing a lot of inquiries, especially over the last 1 year, is on gold, silver, of course. Because of the way the prices have run up, people don't want to miss out. You saw a huge gold has been one of the best asset classes if you see over the last 3 4 years. So people don't want to miss out. They're buying it as either physical gold or is e-gold, open to having allocation to it. The other asset class, specifically on the mutual fund front, where I'm seeing people interested, is something called factor funds. They've done so well. Such schemes do well when there is a market volatility or when the general direction of the market is on an uptrend. But people don't understand that they will also incur losses. They may not, these such schemes may not go anywhere when the market does not perform very well. So these are nothing wrong in them checking out, but I'm saying probably a feeling that I may be missing out on an opportunity to earn good returns. Overconfidence bias is typically happens in a bull run, we see, when a lot of them think that I don't think I will go wrong, or they think that it is my skill, my intelligence, my judgment about a particular stock because of which I'm doing well. I saw this a lot, especially with defense stocks. Recently, a client of mine invested in Hyundai IPO. There were a lot of voices which kept telling in the newspapers, TV channels, which kept saying that probably the stock is a little overvalued. Maybe you should not be looking at it. But he just shut his eyes to that. He was sure that Hyundai IPO, all the IPOs are doing extremely well. Hyundai will also do well, and I'm going to make a lot of money. We all know what happened with Hyundai IPO. I'm not saying it will not correct. I'm not saying it will not go up in future, but we all know what happened with Hyundai IPO. So that's also one kind of a confidence bias that this nothing can go wrong. Also to mention that he's still holding on to the Hyundai stock. Halo or market leader bias. We are in a society where there is so much dissemination of information. There are so many influencers like us, like on YouTube, on TV channels. All of us like following because it's so much learning. Even I watch so many people regularly. And even when I hear somebody, I also get the feeling, oh, this person cannot be wrong. But time and again, we have been proven that everybody could go wrong. It does not mean they are basically not capable in that field or anything of that sort, but their decisions could not have a positive impact. There's a very large fund house which was the person in charge of it still appears in a lot of TV channels and all that. He's a very respected voice, but their particular fund did not do well for almost 3 to 4 years. But as an individual, I still respect that particular entity. So I'm sure it's the same with you people. You would be watching someone, following someone regularly, enrolling for their courses and all that, but you should be careful before you do, and you should ensure you do your own groundwork and don't just blindly go by what they say. Don't assume that what recommendation they are giving has to be correct. Okay, so this is one thing. Anchoring bias is typically for someone who's very frequently investing in the markets. I can give my own example. A particular stock, I saw it at 430 rupees or something of that sort. I thought it was a good buy. I bought. Then the stock went to 600. I hesitated a little. I said, no, 600 is not the right price to buy the stock. Then it went to 800. Then it went to 1200. I could have probably bought more at next levels also, but I was so stuck up in my mind that, oh, 430 is a good price for to buy the stock. I should not be buying for more. This stock would have given me much more returns than a lot of other stocks in my portfolio. But I was so holding on to my anchor bias that beyond this price, I will not buy. I see that with so many stocks on a day-to-day basis. Once we think we have made the right decision in buying it at a right price, we are very careful and very scared to enter at a higher price. Even if there's scope for the stock to run up 2-3 times. It has happened with a lot of recent IPOs that ran up significantly and gave stellar returns for investors. At every level, somebody who's bought may feel, oh, now this is very expensive. Then they see it going another 50 rupees up. Then they see it, then they again, they're like, no, 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 this is too expensive. Again, they see it going another 200 rupees up. So this is called an anchoring bias. On this particular slide, I would probably touch upon confirmation bias and herd mentality. Confirmation bias is, again, I'll go back to the Hyundai stock per client who bought the stock and then kept looking at all the auto related news to see that what he has done is correct. Now he keeps telling me that, see, next 2 years how the stock is going to run up. It's going to do exceedingly well. So it's basically, you look for information, you look for only validation for your decision, and you ignore anything that will negate your viewpoint. The other one is herd mentality. That it basically stems from the belief that maybe most people know what they are doing, most people know that what they are getting into, so it is good if I follow the trend. Like a lot of them investing into gold recently fortunately worked for them, putting a lot of allocation into gold, which we don't support. As a house, we say maybe 5 to 7 to 10% max is good into any commodity or as an asset class. Too much into gold. So that there are a lot of herd mentality things that we come in. People were investing in IPOs. So many of fresh new investors who saw how well the markets were doing also got tempted to invest in IPOs to make that quick money. So generally following a trend without seeing whether it is relevant for me, can I afford it? Can I do it? Okay, that's an herd mentality. So from this, these are the two most important. We will be sharing the presentation. Tara will be sharing. You can have a look at it. Next we'll come to is the emotions part. So wealth is a lot of investing is a lifelong journey. My 20-25 years into this particular domain in various capacities. If there's anything I learned is making money is a long journey. I'm not saying it's tough, it's easy, but it's a long journey. A lot of things come, lot of learnings, lot of mistakes, lot of correct things we do. So it's a mixture of all that. So most important of these amongst these emotions is fear, greed, and sometimes remorse and contentment. These are what that I come across. Pride plays a part. Sometimes maybe I'll give one or two examples where I have come across clients who want to own that, who may not be able to afford it, but want to have that flashy house or the flashy car. Flashy for me, not flashy for them. Let me think, and I'm not judging it. It's their desire, it's their aspiration. Nothing wrong with that. But there's such occasions where probably pride comes, but the most dominant emotions that I have come across are fear, greed, and I would definitely say remorse and contentment in varying proportions. Anxiety comes in. So typically, if you see some major biases that we spoke about, like loss aversion, if you see at the underlying emotion is fear, and it could be fear also, it could be contentment also. Fear because I'm so scared of booking a loss in whatever investment decision I've done. Number one. Contentment because I'm saying, no, 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 I will not get into equities. I'm happy with this fixed deposit returns. I'm very happy with whatever I'm doing right now, my EPF, my PPF. I don't want to get into equities and face a loss. I cannot tolerate this thing. So I'm very happy with the kind of investments I'm in. So it could be one of both the biases. Something like an FOMO is anxiety and greed. oh God, everybody is making money because of this particular investment opportunities. I'm the only one left out. I should not be doing it. I've seen so many young people getting into PIP lending, cryptos because of this. Okay, so it's more an anxiety and greed that I should also be part of the gang that is making the money. Then probably herd mentality is again fear and greed. So every bias, if you see, before you make the next investment decision, probably try observing yourself. What is driving you to make that investment decision, especially in stocks? Most of us, I encounter nowadays, have one part of their investment which is very structured, which they follow as per what the financial planner does, and very good. That's the good part about it. They follow all rules. But there's a small portion of their money which they like to dabble it into, especially in stocks. So when they're buying stocks, it's where they are thinking, their viewpoints, their biases, their lot of emotions and biases come into picture. So the next time you're dabbling in stocks, try observing yourself to see which of these is playing. Is it a desire? Is it greed? Is it envy? Or is it aspiration? Is it confidence? What is it that is coming to the picture? Now, how do these affect? End of the day, why are we doing all this gyan and why are we getting into this subject is to see how it affects our financial planning. Okay. Why do we? So there's a very interesting in that psychology of money book also, this particular thing has been mentioned where in case people have not come across this incident, Ronald Reid, he died in 2014. He apparently worked as a janitor. He worked in a gas station and then he worked as a security guard in some particular building. He frugal living, simple living. So he managed to save and invest a lot of money. When he died, he was left with $8 million. He apparently had donated most of it to charity. It became a big news that how could a janitor, someone with a humble background, manage to have so much money? This is a very famous, you can Google and look into it. It's a very interesting incident. Did he have knowledge? Was he a stock investor? Was he given the best advice? Nothing of it. It was just a simple, regular investing and waiting for the power of compounding to work on his money and staying with the investments. Simple rules that he followed. Just sharing this as an example. Again, I would like to mention, if in case you people have not come across, read the book Psychology of Money, please read it. I still need to keep reading it again and again because there's so many small tidbits. A lot of YouTube channels also on it. You could look into it just to get a sense of what the book is telling you about. So how do these biases and emotions affect your financial planning? We'll get on to a specific example also. So when there is greed, when you know you're made 25% return, 25% return is great. Many clients come to us and say, Madam, how is my investments doing? I tell them you've done 22 to 25%. Ma'am, 22 to 25% markets have done so well. No, I should be getting more. I tell them 25% is good. It's a good return. Then I see a small thing. They're like, I think it will do even better. No, why don't we get into this thematic fund? Why don't we get into this? It's the lure of making more money. When we try telling them that a thematic fund is very, very high risk, tomorrow the market corrects, these are the fund schemes which will first correct. We saw that in defense mutual funds, defense stocks recently. These are the stocks which will first correct. If we try telling them, they're like, but we can make really good money. So sometimes the greed slowly seeps in. So that could affect your ability to make a rational decision. I made 25%, let me just stick to my plan. Second is random investments. What is financial planning all about? It is about systematic approach to achieving your goals. You have a set plan and you follow that plan. What happens when emotions come into picture? Little random investments, maybe that gold chain, maybe that car which you really didn't need, but you always wanted to see yourself driving. And because of which you had to sacrifice on some other or compromise on some other goal. Your desires, it's very important, your desires, if they take over the clarity of your end goal, that is why as a part of financial planning, we also tell people prioritize your goal. If you don't prioritize your goal, there's a very high possibility that the third thing, desires taking over clarity of end goals. Should I be spending this 100 rupees towards my retirement, or should it go towards that two laptops that my children need, which they can also afford to wait maybe for 1 or 2 more years? Is a lot of things that will come into picture. We face this day in and day out. It's just that we don't classify this and as a theoretical concept of behavioral bias or psychology or emotions. People come across this every day in our daily life when we are spending money. Finally, fear. Fear is understanding and patience. Should I wait? Should I stay put? Should I get carried away by this, what is happening around me? This Ukraine war, oh my God, does it mean gloom and doom for the entire world? A lot of things, a fear comes in. So when all these emotions this is what typically happens. Your rational decision-making ability, your clarity of end goals, your ability to stay patient and stay put. Recently, a friend of mine, she had an event where she had to something related to her child. She spent and after a lot of convincing, she had started SIPs over the last 3 to 4 years and managed to accumulate a decent sum. When this function came for her daughter, she sold everything. She's somebody from a particular community where they buy a lot of gold, and there's a lot of physical gold that she has. So my first question to her was, why didn't you sell the gold? She said, oh my God, no way. If I sell gold tomorrow, something happens. What will happen? I said, with great difficulty, you managed to build your SIP corpus, your investment corpus. Why did you touch that? You were already doing around 25-30%. You would have really made a lot of money. It just didn't occur to her. She said, how can I sell gold? No way, I'm not going to do that. So even this is a kind of fear when you're not able to rationally see through what the impact of your decision, and you just do what is subconsciously ingrained in you. Okay, we'll just take, so coming back to again the financial planning thing. Why do we do financial planning? It is to achieve goals. Well, how do you achieve goals? Through structured investments. And when you do, how do you do structured investments? By taking your risk profile and the time horizon of the goals into account. So here also, sometimes we see some biases. Somebody is very conservative. When people come to us, we ask them, what is the kind of, what is your risk profile? We speak a lot to them to understand their risk profile. You can make out somebody who's most of the time been into fixed deposits. Even someone who knows, who understands how markets work and all that, they'll say, no, I'm fine with this much return, which is also good, which is also good quality, the content, and they have the discipline to stick to that particular investment pattern. But someone who is very conservative, maybe they have that loss aversion or fear of booking any kind of losses. We also see aggressive investors who think they can earn more and more money by just making a little changes here and there, or pushing or not exiting at the right time. So you be here also, even in your risk profile, you'll see some deep down, some underlying bias. A lot of childhood things, at least in my case, probably true. I have seen my father invest a lot of, been into investing into stocks. So that probably helped me be from a moderate to high risk kind of an investor, at least when I started out. As I aging, you just shift. But when I started out, I remember I was quite aggressive. I was ready to take those risks. I was ready to put into random stocks, thinking that I'm right, like one of the biases, my confidence bias, that I'm right. I don't think I will go wrong on this stock. Okay, so your risk profile also have a relook at it, because it will tell you a lot about what is the underlying emotion or bias that you have. We'll just take a very quick example. Financial planning is a very, very, very vast topic. All these concepts come into play, but because of paucity of time, I'll just take one example of a child education. This is a little dated data, 2022, but a recent study said that there are two areas where inflation is very high. One is education and second is healthcare. Healthcare is the highest, it's around 14% inflation, and second is education, which is about 10 to 12%. Best example is our school fees of our children. we see the bus fee is only increasing even if the diesel prices are going down. So it's we know every year the fees increases by at least 8 to 10%. So a very simple example that I'm taking, assuming your child is currently 3 years and you want to accumulate a corpus when by the time they turn 18. So you have 15 years left for the goal. Current cost, assuming you want them to do an engineering and per year cost is about 10 lakhs. You want to have 40 lakhs ready when they turn 18 so that you don't have to worry about their education. Assuming this inflation is at about 10%, when they turn 18, this 40 lakhs will actually be 1 crore 67 lakhs. Now, how much money do you need to invest right now? Assuming your whatever investments you make will earn at least 12% kind of returns. One time you do about 27 lakhs. Yearly investment you will do about 4 lakhs. And monthly investment is about 33,000. This is worked out Excel. Because of paucity of time, I'm not showing. I've actually worked out these numbers or this particular example. So if you see, the table says one-time investment to get this 1.67 crores when my child is 18 years, who is now 3 years old, and today's cost is 40 lakhs, is 27 lakhs. If I cannot do the 27 lakhs, maybe I can do yearly 4 lakhs investment. If I cannot do that 4 lakh investment also, maybe monthly, every month I can put 34,000 or 33,955 rupees. Okay, these are the numbers. Now, do we always stick to the investment plan? My experience is no. I do see people sometimes stopping SIP, reducing SIP, increasing SIP. A lot of things happen. Why? Because we suddenly saw this beautiful house. We want to move to bigger house. Home loan EMI is taking more priority. So I will pause for some time. Anyway, my child is only 3 years old. I can afford to wait. I don't know. Anyway, I don't have clarity on what they will be doing. So let me wait. Let me push this goal by 2-3 years. This is very common. Happens. Even I have done it. Others also do it. So somebody who varies their SIP. So when they come to us for financial planning, I would have told them you need to do 34,000 SIP if you want this particular money for your child's education. They'll say yes. The first to third year they do. Then they see that nice car, which they want to buy. Anyway, my child is only 6 years old. Let me buy this car. I will clear the car loan in 2-3 years. And then again, I will start big time. I'll invest even more than this 34,000 for my child's education. Does it happen like that? No, it does not happen like that. Some other responsibility, some other goal, some other commitment comes into the picture. So maybe in the year 4 to 6, you do only 10,000. Then when you again come back, you're not able to do the 34,000. You do only 25,000. If you go on like that, assuming you still manage to earn 12% kind of rate of return on your investments, you will be able to accumulate a corpus of only 67 lakhs as against your corpus requirement of 1.67 crores. So the goal achievement will be only 40%. So here what all comes in, a lot of, without our knowledge, a greed, a desire, an envy that somebody else has a better house, better car, or a better whatever be the clothes, whatever be the case, comes into picture. And so you lose focus of your end goal, the clarity of goals past, and you start doing random investments, unstructured investments. So this is just one example I'm giving. But if somebody who in a disciplined way sticks to that 34,000, they will for sure manage that 1.67 crores. Of course, this is assuming that every year you, on a CAGR basis, your investment manages to earn 12%. Okay, so this is one simple example of where we have seen probably sometimes you're not able to go achieve something because of some deep down one desire or an emotion or a bias. Okay. This table I've just put to show it to you that over the last 15 years, the same time period as what we have assumed as this example, 15 years we need to save. If you see, not every year, assuming even you put it into a simple index fund, not every year have the market given you 12%. There are some years when it has given you very good returns, like 2009 was 75%. This was just after the Lehman Brothers crisis. If you see minus 2015, it was minus 5%. If you see in 2022, we got only 4%. So on accumulate, you'll have to stay put. You'll have to stay invested to see that goal fructifying and you achieving them. Okay. This is something important you need to understand. Every asset class will not give you returns every year. Gold, best example, 2011 to 2018 did nothing. From 2018 onwards, if you see the kind of returns, people who invested in sovereign gold bonds around 2016-17 have made a killing, really good returns. But somebody who got in probably 22-23 may comparatively, when compared to somebody who did it in 2016-17, is not so great. So coming to the last part of the session, general sounding boards. Okay, I've given two examples that I really like. And I hope even you like them. One, you may have heard so much about power of compounding from people like us on media channels, articles, and all that stuff. Definitely the eighth miracle. There is no other way to experience that power of compounding than by actually doing it, actually by going through the process. So understand and leverage the power of compounding. That's why I'm saying you have to be in it to know how. The first 10 years you may not see anything, but after the 10th year, it just works like magic. It's amazing how the money grows. View volatility. The earlier slide which I was showing to see how the thing is also to tell you that not every year you will get that kind of returns. There will be volatile years. Like the current year is expected to be a little volatile for the markets. You will go through this journey, this phase also. So look at them as a learning phase, as something where you need to stay put, you need to stay invested, and you need to accumulate. Two great examples. The first is of NVIDIA. I think that's how you spell this company. If you see between 2014 and 2023, the stock did nothing, practically nothing. And look at the run up after that. Someone who had a conviction on this particular domain, this particular industry, chip industry, and all that stuff, look at the kind of returns they would have made in the last 1 year. It requires a lot of patience, conviction, confidence, understanding to have stayed invested in a stock like NVIDIA to earn this kind of a return. I think it's a beautiful example of patience, how patience can pay. If you thought the management was good, if you thought the idea was good, and if you could afford to stay invested. The other beautiful example is from our Indian market, Page Industries, manufacturer of the jockey brand. This is very personal because at one point I was also associated with their IPO. It's a beautiful thing. If you see 2000, this IPO actually came in 2004 and they were at, they came at 350 rupees. Trust me, there were no takers at that time. Even in 2008, as per this chart, which I pasted only this morning, the price was only at about 308 or something of that sort. Today, it is close to over 45,000 rupees stock. The kind of returns at this stock, if you see, return is 17,615.23% according to Value Research website. So power of compounding really works. You need to have the conviction that things will turn around, provided it's a reasonably good investment. You put it into a trash investment, no, but if you have to wait, you'll have to see it for yourself to see how it grows. Second sounding board is gratification. There will always be wants, there will always be needs. Your battle will always be which balance should be tilted at any point in time, given your stage in life. Do I need that nice piece of jewelry, or do I continue with saving for my retirement? I'm just giving a very random example. So you will always have that desires. This is a constant battle at every stage in life. So it's something for you to be aware of and to fight it out. Lot of us, today credit is very easy. You go for anything, you have loans. Washing machine, you have loans. Laptops, you have loans. Phones, you have loans. Every particular product, you have loans. It's your choice. Is this a good debt or a bad debt? Am I, by taking this loan, simply accumulating an unnecessary loan? Or is it for something that will help me in future, like an education loan or a home loan or something else for some business? So be very careful before you take these kind of personal loans and all that, to just have that nice life or a desired life. The price you pay is time, definitely, by sacrificing it, but probably sometimes it's worth it. So differentiate between true wealth and being rich. We do come across people with who are probably not as financially well off as they seem and appear to be. So be aware that you also don't fall into the same trap. Having money does not mean spending money. The people who are truly wealthy, you will not see them spending so much in a very obvious way. Always aim for a financial security. As you grow older, many of you may be very young. I don't know the age profile of the audience. The peace of mind that financial security gives you cannot be explained. It's something you will realize only with age. It is worth the sacrifices you do probably in your younger years. Fourth, finally, we are going the way US is or many other developed countries are. Lot of loans easily available, credit easily available, and as an economy, we are going to grow only like that. Nothing wrong about it, but on a personal standpoint, understand whether this is a good debt or a bad debt. Last is black swan events. There will always be a black swan events. Two very famous black swan events is one is a 1987 market crash. It's called Black Monday, where on one day the stock fell by about Dow Jones fell by about 22%. Okay. There was panic, there was fear because people had not seen such a dark day earlier. Many of them sold, many of them exited the markets out of fear. This is one black swan events. There would have been many in between. Probably the Gulf War was one. What recently, which many, if there are young people in the audience, or you would associate with is COVID. When the markets crashed by almost 20-25% on one day, we saw people selling their investments, hard investments that they had accumulated over many years out of fear. The loss that they incurred, what they sold is permanent. But after that, from 29,000, today markets are touching almost 80,000, the Sensex, I mean. So these events could be temporary. So please internalize this, that black swan events will happen in your investment journey. You should use it as an opportunity to understand it and not to panic and not to run away in fear. So loss is permanent, market correction is temporary. Please understand that. Bouncing back in investment journey is equally important. The last sounding board I would probably say is pessimism. A lot of them, this I've seen even in probably in the field of cricket. I've come across people who come and tell me, you know, that match fixing, after the match fixing incident, I've completely stopped watching cricket. Who's the loser? You have stopped, you have missed out on many beautiful matches, beautiful sport. As a sport, it's so much fun to watch. Any sport for that matter. So don't let the allure of pessimism. Things will not always be wrong. Things will change. If the economy is not doing well, it will change. Many things will improve, especially in a country like India. Second, if you have made mistakes in the past, earlier you invested only in FD, you missed out on a lot of opportunities, it's okay. You can start even now. So don't hold on to that pessimistic mindset. And they are called tail events. Last year, if you see the kind of run up the market showed, many people who are not making very great returns covered up for it completely over the last 2 years. So there will always be tail events. Every year is not going to give you a return. There will be tail events which will really change your fortunes. So understand that. So you don't hold on to that pessimistic, oh, I invested, I burnt a lot of money, I'm not going to touch it again. Not necessary. Probably it was your mistake. Probably you didn't take care of certain aspects of that particular investment product or asset class. So don't hold on to it tightly. Let it go and have a fresh look if it is something that will actually help you achieve your goals faster. So avoid some other common pitfalls is please be very careful with this quick rich, get rich, quick rich scheme. Sorry, my rich spelling is wrong. Be very careful with any investing guru, including us. You need to understand, use your own discretion before trusting anybody with your financial plan, with your money. Be very careful before you spend something to boost your image. Do you really need that grand party? Do you really need those grand clothes? Is something that you need to relook at. And one size fits all approach is this herd mentality. You need to know yourself. You need to know about your requirements, your circumstances, your background, your desires, your goals. Uh, be very careful not to be carried away by social media, by what people are showing to the world, which may be very different from reality. So don't have this herd mentality approach, and stick to your basics, stick to your values, and that will keep you grounded, at least financially. Financial security gives you a lot of peace of mind. We will have enough other issues to handle in life. So at least let's take care of this particular part. So investing is a lifelong journey. Wishing you all the best. Wishing you all a very happy new year. Use this opportunity, this beautiful new year, to set right, probably if your finances are still not in order. And again, once again, wishing you all a very happy new year.